this is how criminalized our financial system has become today. If the bankers perpetrate a crime and they're not convicted or at least charged of a crime, all we have is it's called a precedent. If you commit a crime, you're not punished for it. It's not a crime anymore. It's a precedent.
A must-own gold stock. Head of exploration is the man responsible for the largest gold discovery in history. Gold production will commence in the matter of weeks for this new company, headed up by an all-star management team. Their core project and mine was purchased by Barrick Gold at the height of the bull market in 2006 for $142 million. At the depths of the bear market, this management team swooped in and bought this project for $2 million last year. To learn more about this soon-to-be mid-tier gold producer with a cash cost estimated at a low $600 per ounce, visit crushthestreet.com/gold IPO.
Hello, everyone, and welcome into crushthestreet.com. We got an expert on the line today. His name is Jeff Nielson, and he's the co-founder and managing partner of Bullion Bulls Canada. He's a contributing writer for Sprott Money and is covered regularly by the biggest alternative media sites on the internet and is a rock star in the alt space. He provides precious metals commentary, economic analysis, and mining information to readers and potential investors. So, Jeff, thanks for coming on the line with me today.
Well, thanks for having me, and thanks for that flattering introduction, although I think you might be going a little far with rockstar.
Rockstar. You're a rock star, Jeff, and I want to talk to you about an article you recently wrote for Sprott Money, and it was really interesting to me, and it was comparing bubbles to bubbles. As you recently put in an article you wrote, the corporate media has been talking about with tunnel vision, talking about basically China being in a bubble and failing to see the bubble that exists right here in the States. And let's start off with this. Where is the hypocrisy and disconnect with the corporate media and them talking about China being in a bubble, but not the U.S.?
Well, and of course, this is something that's a general pattern in the reporting of the corporate media, which is that they don't provide perspective. You know, they'll shine the spotlight on something in isolation and then provide their hyperbolic analysis to it, and of course refuse to provide the perspective that allows the audience to truly see the facts that they're reporting in their proper context. And so that was what I was trying to get to when I made my comparisons of U.S. bubbles versus China bubbles. Give people perspective so they can make an accurate comparison and see how the two economies stack up versus each other.
So let's talk about that perspective just for a moment here. $1.5 trillion in global derivatives versus China's debt problem you compare as a mountain next to a molehill. How in the world does a derivatives market get 20 times larger than the global economy? And is this much more concerning than what China is dealing with?
Well, it's certainly more concerning just because of the difference in proportionality. You know, 1.5 quadrillion of derivatives bets versus China's markets, which are, you know, at least somewhat proportional to the U.S.'s markets as well. And of course, the way that the derivatives casino has grown to such a monstrous and fraudulent size, it has to do with the nature of this so-called market. And what I think a lot of people don't really understand, because of course it's all hidden in euphemisms and the financial jargon of the bankers, is that derivatives are literally nothing but bets. And of course, this is how the derivatives market is separate from any conventional market. You know, conventional markets are more or less based upon tangible assets. You know, the stock market is based on equities, which is the tangible interest of corporations. You know, the bond market's based on bonds, commodity market's based on commodities. The derivatives market has no tangible foundation. It's betting on markets. It's betting on commodities. It's betting on bonds. So, of course, if you're talking about pure gambling, then there's no finite limit how big this so-called market can grow. You can place any amount of bets on anything. You know, you could bet $1 quadrillion on whether it's going to be sunny or it's going to rain tomorrow. And so this is what the derivatives market is. It's an unrestricted casino. And in fact, a lot of the betting that takes place in this casino used to be explicitly illegal. For example, credit default swaps were banned for 100 years based on anti-gambling statutes. So, this is a totally fraudulent casino with basically no rules, run by a crime syndicate. And as you mentioned, it's 20 times larger than the economy, which they're placing bets upon.
So you pointed out that it's bets on the bets, basically, bets on the debt. So if the debt shrinks, what does that do to the 1.5 quadrillion, I said trillion, 1.5 quadrillion value of derivatives that are out there if just the debt shrinks or collapses just by a small amount?
Well, it's impossible to answer any question like that in specifics without knowing specifically what direction the bet's going in. So, of course, if the bets are that there's going to be if the bets are heavily stacked towards, for instance, debt defaults, then if debt defaults occur, it will trigger massive payouts. And in theory, that increases the size of the derivatives market. But of course, the problem is the banking crime syndicate that runs this market only holds a microscopic fraction of the assets required to make payouts on a lot of these bets. So, for instance, when Greece defaulted in 2011, defaulted in 75% of its national debt, that was supposed to trigger massive payouts in the credit default swap market. And something else that people might not know in your audience is that credit default swaps tend to be extremely leveraged bets, very high odds. So when Greece defaulted on $300 billion of debt, it could easily have triggered trillions or even tens of trillions in payouts on those bets. And, of course, the big banks only have a few billion backing all of this insane gambling. So what happened in 2011 is the big banks, who are also allowed to, quote-unquote, regulate this casino, simply decreed that Greece's default was not a default. And so, not only is it a casino, it's a crooked casino because the house doesn't pay when it loses.
Yeah, I was going to ask you, who's going to get hurt when the casino defaults here, and who's ultimately going to pay for this and be affected by the massive expansion of the credit system that we have going?
Well, there's really only two possible directions in which it can go. It can implode via the big banks attempting to make payouts on some massive bet where they don't have enough assets. And then, of course, we just have this domino effect where this entire leveraged, ultra-connected system of fraud and corrupted finance just cascades within itself. The other way that this paradigm of fraud can come to an end is through some similar event to what we saw in 2011. At some point, the people who participate in this market are going to say, well, if we don't get paid when we win on our bets, what's the point of participating in this market? And the market will simply become discredited and it will be abandoned by anybody except the banking crime syndicate itself.
Jeff, do you see bail-ins as a likely possibility for the banks to lessen the blow on their problems? Going after the people's money, directly taking it from their bank accounts. Is that where this is headed?
That is a very strong possibility. I've written extensively on this subject, probably more than any other writer, and virtually every government in the Western world has already completely entrenched bail-in provisions into their own financial system. And of course, when we had the original so-called bail-in, the naked theft of assets in Cyprus, what we had was pure choreography. We had all of these puppet governments lining up one after another to call this act of crime a quote-unquote precedent. And this is how criminalized our financial system has become today. If the bankers perpetrate a crime and they're not convicted or at least charged of a crime, all we have is it's called a precedent. If you commit a crime and you're not punished for it, it's not a crime anymore, it's a precedent.
Wow. Jeff, I wanted to ask you about gold here. We're seeing gold at the moment, 12.15, down. I mean, not down a whole lot today, but, from close to 1,300, hitting 1,300, and then coming down. We're seeing a pretty significant pullback, and I know some people are going to be getting heartburn looking at this, and it being very reminiscent of what it felt like dealing with the bear market over the last few years. Is this seem like a bear market type move, or is it just a normal bull market correction?
No, I think you've hit the nail on the head here. What we've seen in particular over the last few weeks is this so-called rally, which I've labeled a fake rally from the first moment it started. This fake rally has morphed right back into the same paradigm of hostage markets, which we've seen since 2011. And the basic gist of the paradigm is that we have the liars at the Federal Reserve simply repeating the same lie they've been uttering for 7.5 years, that we're quote-unquote going to raise interest rates. And every time they say this, even though there's no substance to it, the bankers then hammer precious metals prices lower. And what I pointed out in another recent article about this fake rally is that if you go back to the period from 2009 to early 2011, when we had a real rally in precious metals, we were seeing the Fed talk about raising interest rates all through that rally. But when there was a real rally in precious metals, the markets ignored the talk. The Fed didn't actually raise interest rates, so precious metals prices kept going up, and nobody paid any attention to the liars at the Fed. Then we had the turnaround in the paradigm in 2011, the imposition of hostage markets into gold and silver, and everything reversed. Then all that happened since then is every time the Fed had talked about raising interest rates, even though they have no credibility, precious metals prices got slammed lower. And of course, the point here is that each time during that 5.5 years where the Fed talked about raising interest rates and didn't do it, when they didn't follow through, the prices never came back up to where they were when they were slammed down on the talk. So, this is another obvious example of the fraud that's inherent in this price rigging, is the market goes down on the lie, but it never goes back up when the lie is exposed.
Jeff, is there any other reasons why you would consider this to be a fake rally?
Well, I think one glaring reason stands out in particular, and it starts off with the gold-silver price ratio. At the beginning of the so-called rally, the ratio was at approximately 80-1. And your audience needs to understand the significance of this, because what it means in financial terms is that if only 1.5% of the money entering this sector went into silver, then as a matter of arithmetic, the price of silver would have to rise faster than the price of gold. And so what we're supposed to believe during this so-called rally that's taken place over the first 4 months or so of this year is that less than 1.5% of the money going into the precious metal sector has been going into silver. Everybody's been buying gold. Nobody's been buying silver. I mean, and not only is that absurd just from an absolute standpoint, but if you look at the physical market, the real market for precious metals, the amount of money going into silver is roughly proportionate to the amount of money going into gold. So if that ratio of investing had also taken place in the bankers' paper markets, we would have seen the price of silver rising approximately 20 times faster than the price of gold. And we haven't seen anything remotely close to this, which is another reason I've labeled this as an artificial move by the bankers themselves.
Interesting analysis, very interesting analysis. Something I would point out is that in December 2015, after the Fed raised interest rates, going into 2016, precious metals did rise pretty dramatically. And I know a lot of people are concerned about what the Fed are going to be doing in June here. And I'm kind of curious. I kind of think that even if they do raise rates, that it might have that similar type effect, especially if we see the volatility enter the stock market. We see that flight into precious metals and precious metals going into bull market territories, crossing that 1,300, 1,310 support level, resistance level, and then taking off from there. Any thoughts on that, Jeff?
Well, there's another entirely phony element in the analysis of the mainstream media when they continually bash precious metals prices lower because of talk of raising interest rates. And the fiction here is that rising interest rates are only bearish for precious metals if we're talking about interest rates at some rational level. We have interest rates across the Western world frozen at by far the lowest level in history, and we're listening to these corrupt governments talk about maybe raising it a quarter point here, maybe raising it a quarter point there. I mean, if the Fed raises interest rates 3 more times, it gets up to 1%. That would still be historically extremely low by any rational, legitimate standard. So, I mean, if we were already at 3%, or even 5%, and the Fed was talking about raising interest rates, the argument that this is bearish for precious metals would have some validity. But with a Federal Reserve which has its benchmark rate currently perched at 0.25%, talking about raising it to 0.5%. I mean, this is just it's absurdity. I mean, making some minor incremental increase from ultimately low interest rates can in no way be construed as being bearish for precious metals.
Do you know if we're seeing an influx of people buying with this correction here? I can only imagine that people that feel like they missed out on, the early months of 2016, kind of what happened in the junior mining space from September and, into January. And now with this pullback, it's almost like a blessing for everyone who's been on the sidelines. I'm wondering, and even like the hedge funds that have been on the sidelines, I can only imagine what people are doing now, taking the opportunity to enter this as, a pullback, as a correction, and find some good values while the metals are pulling back. Are you seeing that on your end?
Well, I'm not personally involved in the actual retailing of precious metals, so, I don't have that same sort of hands-on information that you would get from an actual bullion dealer. What I've heard from talking, with bullion dealers is that what spurs their demand is prices changing. If they go up, people pile in because we have so many people who have been conditioned to be bandwagon chasers. They jump on the bandwagon when something's high. Instead of the old mantra of markets of buy low, sell high, we have all of these momentum chasing idiots who try to buy high and sell higher. So if prices are rising, that spurs physical demand. Conversely, if prices are falling, that also spurs physical demand, but from a different segment of the market. It's the value buyers. So the momentum chasers pile in when prices are rising. The value buyers pile in when prices are falling. What kills demand on the physical side is when prices are flat. And so, of course, this was part of the reason for this paradigm of hostage markets over the last 5 years or so, where, prices were moving lower, but they were doing so generally in a very gradual rate. We'd have occasional hiccups where they would take plunges, but for the most part, it's been this sideways to lower grind rather than dramatic moves in either direction, which would spur a lot of physical demand. So I think that's another element of this paradigm of manipulation, is to try to avoid dramatic moves up and down in the precious metals markets as much as possible. And that's, of course, another reason why I consider this to be a fake rally. It's been, of course, blessed by the big banks and all the mainstream media as being this, new long-term rally in precious metals. And yet, the bankers are the last people in the world that would ever want to advertise a real rally in this sector, because higher precious metals prices are anathema for their own paradigm of paper fraud.
So, Jeff, expound on that a little bit. This fake rally, what exactly are you talking about? Are you talking about the 2016 move in precious metals? Is this whole thing a fake rally? So, if so, where do you see gold and silver going from here?
Well, if you buy into what I'm saying as far as the fake rally goes, it plays into what I've been writing about for the last 18 months, which is that we're due, or in fact overdue, for another manufactured crash in our markets. What we've seen over the past 1.5 decades is that these bubble and crash cycles that the bankers run last for approximately 8 years. We had a crash around 2000, we had another crash in 2008, so we're due for a crash in 2016. Of course, that's predicated on the assumption that the next crash will be triggered from an economic cause. And the reason that the crashes are scheduled then for roughly this time period is that it allows the big banks to label the outgoing political party in the U.S. as the scapegoat for the crash, and then hail the new political party coming in as the supposed saviors that are going to rescue everybody. And so this is the game that's been going on for the last 16 years or so. And if that remains true to form, and we're going to be seeing markets crash in the next few weeks or possibly a couple of months, I cannot see the bankers ever allowing precious metals to rally while all of their own paper assets are plunging. We didn't see it in 2008. Despite the fact that gold and silver are safe havens, when the crash of '08 came upon us, the bankers crashed gold and silver markets hard, and they crashed them deliberately so that people would not see those metals as safe havens. So that's what I expect to see happen in the next crash, and that's why I label this a fake rally. See, of course, at the end of 2015, precious metals prices were already at rock bottom lows. So if the bankers want precious metals to be plunging lower at the same time all of their paper assets are plunging lower, what they needed to do was to march prices higher first, because it's hard to crash something that's already at a rock bottom level. So this is the purpose of the fake rally, to raise prices up so that they can crash them harder when everything else goes down.
You mentioned the election cycle here. We got Hillary, we got Trump. I guess Bernie Sanders is in the running too, but it doesn't look like he's going to take out Hillary in this race here. Would you say, since I know you've done some thinking on this, would you say the stock market is likely to do better under Hillary or Trump in the sense of the crash? And I would tell you that I'm a little concerned, more concerned about the stock market if Trump gets in, because he's not the establishment candidate. Hillary is the establishment candidate, and I would imagine that they would want things to look better under her presidency than a Trump presidency. So any thoughts on this?
Well, first of all, I'm starting to question whether Trump is or is not a quote-unquote establishment candidate. Of course, he brought in a Goldman Sachs banker as his new money man, and you can't get much more establishment than that.
You're right. You are right about that.
So, and of course, the other thing we saw is once it became certain that Trump was going to be the Republican nominee, in the national polling, we saw this very dramatic spike towards Hillary Clinton. There was a period of several weeks, a couple of months, where it was being reported that Trump was basically unelectable versus Clinton because, she supposedly was too popular. And then all of a sudden in the last few weeks, the poll results have tightened up considerably after Trump brought in his Goldman Sachs money man. So, for me, this is all just theater. The bankers control the media controls the thinking of the U.S. electorate. They can tell the media that now Hillary's unelectable. And you see, the thing is here is that both of these candidates have so many black marks against them of one sort or another that, it doesn't take much to torpedo either one. All they basically have to do is tell the truth and shine the spotlight brightly on them. It's in fact almost the opposite. The only way that either Trump or Clinton can be made electable is by hiding as much as possible what they really represent. So for me, these politicians are nothing more than interchangeable parts. The bankers don't really care as far as their own plans go which one is taking their orders, as long as they are taking orders.
Well, it's good words right there, Jeff. I wanted to get your final thoughts here. Is there anything else that you wanted to add regarding gold, precious metals, or just your advice in general for people who are entering 2016 and just want to know what to do with their money? What's your overall general advice?
Yeah, well, thanks for giving me this additional opportunity, because I want to clarify something here, because, of course, I'm talking about, this fake rally in precious metals, and, people might listen to that and think that I'm actually some sort of a natural bear concerning precious metals, even though I run a precious metals-based site. And, of course, that's the farthest thing from the truth. I'm extremely bullish about precious metals in terms of what they represent as assets, safe havens, and as real money. And the reason I've been warning people about this fake rally is, of course, not to deter them from investing in precious metals, but actually the opposite. To prepare them for the fact that if they're buying now, they should expect prices to go down before they go up. But at the same time, I would strongly encourage people who are interested in getting into this market not to wait. Because the problem is that even though prices may very likely be crashed over the short term in the future, people wanting to try to get into the market at that time may simply find that there is no inventory available. During the crash of '08, for instance, silver in particular was almost impossible to buy. All that remained available at the retail level was the largest bars. All of the coins were sold out. All of the smaller bars were sold out. So, I mean, unless you're a fairly large investor wanting to get into those large bars, there was no possibility of entering the silver market in 2000 during the crash of '08. We've seen increasing signs of tightening in the gold market as well. So if these metals are crashed again in later this year or perhaps even next year, we could very easily see a situation where prices are at this incredible artificial low, but there's no real metal to be bought. And I would strongly encourage all of your audience to stay away from the bankers' so-called paper bullion products. They are all rife with various forms of fraud, and the general axiom in precious metals is if you want to buy gold and silver, you buy something you can hold in your hand.
Well, it's good words right there, Jeff. Jeff, thanks so much for coming on the show with me today. I do appreciate it, and I know the audience does as well. Thank you.
My pleasure.